Hey everyone, welcome back to Corporate Decoder. Today we're diving into Procore's latest quarterly report. It's like peeking under the hood of a construction management giant, but don't worry, we'll be using our own set of architectural plans, making sure nothing crumbles under pressure. And before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss the report and more. And we're looking at Procore Technologies Form 10Q, their report card for the first 3 months of 2025, the key takeaway. They're still growing, but some expenses are climbing faster than a skyscraper. We'll break down where they're making money, where they're spending it, and what it all means. Let's start with a snapshot of their financial health. It's like looking at a building and seeing if the foundation is strong. We will be diving into what assets and liabilities are. First off, their cash and cash equivalents, that's the money they have right now, ready to spend, dipped from $437 tier to $313 here to the end of last year to $313 gig, a hefty drop. Let's keep going. Their accounts receivable, which is money owed to them by customers, took a big hit from $246.4 million down to $161.45 million. That drop is about 34%. It means they brought in a lot less customer money during the start of this year. Now, onto how they actually performed during those 3 months. Their revenue, the total amount of money they brought in, increased to $310.6 million compared to $26.920 million a year ago. So revenue increased means they're selling more or charging more or both compared to last year. Sales and marketing expenses also went up from $120.9 million to $138.6 million. That extra $17.7 million is like adding another floor to their marketing efforts. It shows they're spending more to attract customers. This might be due to the growth that they mentioned. And this is the major important part, net loss, which is the amount of money lost got worse from a loss of $10.90 million to a loss of $32.9 million. This means that after all expenses, Procore ended up losing more money. That is not good. Procore operates as one single segment, which means all of the products and services they sell are considered as one segment. This indicates that the CEO is not looking at individual revenue or expenses for certain segments. The fair value of their investments, that can change based on economic situations. CAFIC, for example, for corporate notes and obligations gross unrealized losses, went from 67k to 51k, meaning they lost value, even if they have not sold it yet. It indicates that the bonds got worse in value. The company is partially self-insured for their health plan, which means they pay for small expenses, but maintain an insurance to reduce risk for high dollar amounts. They are expected to pay $2.9 million for not yet reported claims. Now let's get into some other financial details. Procore acquired Novarenda, a building information modeling company, paying $44.3 million. This move created a $23 million increase in goodwill. Goodwill is a measure that is based on accounting rules representing the value of the acquired company that isn't directly tied to any specific asset. It reflects things like brand reputation or customer relationships, which are hard to put an exact price on. The company measures cash equivalents and securities at fair value, using the following levels of Level 1 prices from active markets, Level 2 similar assets without active prices of Level 3 measurements that are not observable on the market. Procore only has one operating segment. It's a metric that makes it easy to track progress of the company's strategy without the noise. The company has a contractual obligation to provide additional investment funding of up to $6.2 million at the option of the limited partnership investees. This means Procore might have to put more money in the near future. The company uses operating leases to expand offices, meaning it rents instead of owning them. The company also used finance leases for offices. They have about $71,000 total across both types of leases. Next up are what they are committed to. This is what they need to pay. Procore has $94 million in purchase commitments for hosting services to be paid through February of 2028. Let's peek at executive and employee compensation. The 2021 Equity Incentive Plan allows them to issue stock options and awards. 9 million shares of common stock is authorized under the 2021 plan. Procore is buying back its own stock. This can reduce the number of shares outstanding, potentially increasing the value of each remaining share. They bought back about 1.4 million shares at an average of 68.296 for a total of $100 million. How much is the company paying on taxes? For the quarter, income tax expenses increased to $5.3 million due to foreign tax. Finally, it's important to be aware of recent events not shown on the 10Q report that can alter the picture in the future. There were changes to their Austin, Texas office leases and commitments that were made to expand the lease premise and extend the lease terms. So what's the overall story? Procore is still growing revenue, which is good. However, expenses are ballooning, leading to bigger losses. They are buying back their own stocks, which means they think they are a good deal. There is also the recent investment of Novarenda. Based on these factors, it seems Procore is at a crucial point. They're spending big to grow, but they need to show that those expenses can turn into bigger profits down the line. Alright, that's our breakdown of Procore's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.